Take a long, hard look at your screen, because what you're seeing right now is not supposed to happen in a free market. In the last 48 hours, the global silver market transitioned from a steady climb into a vertical parabolic explosion. We watched in real time as silver blew past $85, then $90, screaming toward the $95 mark with a velocity we haven't seen in over 50 years. And then, suddenly, the screens went dark. The numbers stopped moving. The heartbeat of the global silver trade flatlined. Welcome back to the channel. If you were watching the tickers on the Chicago Mercantile Exchange or the London Metal Exchange this morning, you saw the halt bars flash red. Within minutes, the official statements began rolling out. They used the same old script we have heard 1,000 times before. They told us it was a technical glitch. They cited unforeseen connectivity issues and data feed irregularities. But we have to ask the question that the mainstream financial media refuses to touch. Why does the cow glitch only seem to happen when the big bullion banks are on the hook for billions of dollars in losses? This isn't just a computer error. It is a circuit breaker for a system that has run out of physical metal to back its paper promises. While the CME and the LME were frozen, something even more seismic was happening on the other side of the world. After decades of absolute dominance, Benjamin Netanyahu is gone. The political old guards of the Middle East has been decapitated at the exact same moment the Western financial plumbing has burst. Our core thesis today is simple but explosive. We are witnessing a synchronized dual collapse. On one hand, the paper-silver pricing system is disintegrating because it can no longer suppress the physical reality of a supply deficit. On the other, the geopolitical anchors of the last 30 years are being ripped up. Today, we go deep into the data, the halts, and the history being made. This is the end of the suppression era. Let's get into it. To understand why the system is fracturing, we have to look at the specific timeline of these technical failures. On February 25th, 2026, the Chicago Mercantile Exchange, the primary hub for silver price discovery in the West, halted all metals trading on its Globex platform. This didn't happen during a quiet midnight session. It happened at 12:11 Central Time, precisely when silver was testing the $91 resistance line. The timing was more than suspicious. It was surgical. Just 48 hours later was the March 1st notice day, the critical deadline when traders must prove they have the physical silver or the cash to back their bets. By shutting the doors, the exchange effectively silenced the bulls and gave the short sellers a desperate window to breathe. But the chaos wasn't limited to Chicago. Just this morning, Monday, March 16th, 2026, the London Metal Exchange followed suit. The LME suspended electronic trading for copper, aluminum, and zinc starting around 1440 GMT. For 3 hours, the world's oldest industrial metal market went dark. While they claimed it was another technical glitch, the reality on the ground tells a much more frantic story. The exchange was forced to use what they call a backup pricing waterfall to determine closing prices. When you are forced to use a backup mechanism for the most important industrial commodities on Earth, you aren't running an exchange. You are managing a crisis. We are seeing a breakdown in the digital infrastructure that handles trillions of dollars in trade. And it is happening exactly when supply chains are under the most pressure. Why is this happening now? Let Einses look at the math problem that the bullion banks are terrified you will discover. In the last week alone, the COMEX lost 33,450,000 ounces of physical silver from its registered vaults. That is 26% of the total available inventory, gone in just 7 days. As of today, registered stocks have collapsed to 86,100,000 ounces. To put that in perspective, the delivery demand for the March 2026 cycle represents more than 60% of everything that is left in the vault. There is zero margin for error. As Peter Schiff recently noted, a technical difficulty is the perfect excuse to stop the tape when the alternative is admitting you are out of physical metal. This is a paper fire, and the exchanges are trying to put it out by simply unplugging the smoke detector. While the Western exchanges were flickering out, the geopolitical tectonic plates of the Middle East were undergoing a permanent shift. The news hit the wires like a lightning bolt. Benjamin Netanyahu, the longest-serving prime minister in the history of Israel, and the primary architect of its modern security doctrine, has exited the political stage. After years of survival through multiple election cycles and intense legal battles, the Netanyahu era has officially come to an end. This isn't just a change in leadership. It is a decapitation of the status quo that has governed the region for over 15 years. For the silver market, this represents a massive injection of war risk premium that the algorithmic traders simply weren't prepared to price in. The departure of Netanyahu occurs in the middle of Operation Roaring Lion, the most significant military campaign against the Iranian regime in decades. Just days ago, we saw Netanyahu standing at a podium claiming that the partnership between Israel and the United States was 100 times stronger than anything seen in history. But with his sudden exit, the old guard strategy of regime change in Tehran is now facing a massive vacuum. The markets are terrified of what comes next. Does a new, more hawkish cabinet take the reins to finish the job, or does a centrist coalition try to de-escalate, leaving the region in a state of chaotic limbo? When political certainty evaporates in a nuclear-sensitive region, investors don't wait for the dust to settle. They run for the safety of hard assets. This is where the silver narrative gets truly explosive. For years, silver has been suppressed by the petrodollar stability, a system where Middle Eastern oil was traded for dollars, and those dollars were recycled back into Western debt. Netanyahu was a key player in maintaining the Abraham Accords and the alliance that kept this financial plumbing intact. With him gone, that stability is fractured. We are already seeing the Trump factor at play, as the United States administration indicates that the future of the Middle East will now be decided on entirely new terms. If the new guard in Jerusalem shifts away from the current military path, or if they double down without the same diplomatic cover, the safe haven, trade for silver won't just hit $95. It will blow through $100 without looking back. You have to understand, the market isn't just reacting to a change in a prime minister. It is reacting to the death of a 30-year-old geopolitical certainty. The roaring lion is out of the cage, and the handlers have just left the building. While Western traders are staring at frozen screens in Chicago, the real price discovery has migrated to the east. We are currently witnessing a historic arbitrage gap that is effectively breaking the back of the global silver market. In January 2026, a massive $39 price gap opened between physical silver in Shanghai and the paper-heavy COMEX in the United States. While the West was struggling to hold $84, silver in Shanghai was already being traded at $123 per ounce. This isn't just a minor discrepancy, it is a total divorce. The reason is simple. Shanghai doesn't trade paper promises. The Shanghai Gold Exchange and the Shanghai Futures Exchange are built on the physical movement of metal. In China, if you buy silver, you expect to take delivery of 99.99% pure industrial-grade bullion. They are not interested in the 356-to-1 paper-to-physical ratio that currently characterizes the Western markets. This shift is being accelerated by a massive institutional pivot in India. Just days ago, on February 26, 2026, the Securities and Exchange Board of India, known as SEBI, issued a landmark circular that changes the game for one of the world's largest silver consumers. Starting April 1st, 2026, Indian mutual funds and silver ETFs will stop using the London Bullion Market Association as their pricing benchmark. For decades, the LBMA in London has set the global price, which India then adjusted for taxes and duties. No more. SEBI has mandated that these funds must now use polled spot prices from recognized Indian stock exchanges, such as the MCX. This is a structural debenching from the West. India is effectively saying that London-esque paper prices no longer reflect the reality of the physical silver market in Mumbai and Ahmedabad. Think about the implications of this East-West divorce. India imported nearly 190 million ounces of silver in 2025 alone. That is roughly 1/4 of the entire global mine supply. By moving to domestic pricing, India is creating an institutional buy and hold demand that bypasses the Western short sellers entirely. When you combine this with the new SEBI rules allowing equity mutual funds to allocate up to 10% of their assets into gold and silver, you are looking at a tidal wave of new demand. Potentially 34 million ounces of new institutional buying in 2026 alone. This is happening at a time when the world's largest primary producer, Fresnillo, has already cut its production guidance by 9%. The West is trying to control the price of a metal they no longer possess, while the East is building a new financial architecture based on the metal they actually hold. The glitches in London and Chicago are a desperate attempt to ignore a reality that has already crossed the Pacific. Now let's look at the technical anatomy of this explosion. If you pull up a long-term monthly chart, you will see a cup and handle pattern that has been forming for nearly 46 years. This is the granddaddy of all bullish setups. The cup began back in the 1980s, and the handle has been consolidating since the 2011 peak of nearly $50. When silver broke $65 earlier this year, it wasn't just a rally, it was the completion of a multi-decade base. We are now in what technical analysts call price discovery mode. This is why the volatility is so extreme. We have strong support sitting at $78.80, a level that was formerly a major ceiling, but has now flipped into a solid floor. As long as we stay above $78, the structural bull market is not just alive, it is accelerating. The immediate battleground is $92. We have seen 3 distinct attempts to close a weekly candle above 92, and each time the exchange glitches we discussed earlier have conveniently appeared. If we get a daily close above $95, the next Fibonacci extension level sits at $127. However, we must remain objective. On the 4-hour chart, there is a head and shoulders pattern trying to form, a classic sign that the banks are attempting to paint the tape to trigger stop-loss orders. Bank of America has released a bull case, target of $309 per ounce by 2027, while JP Morgan remains conservative at $81. The gap between these two estimates is $28, which tells you that even the giants can't agree on where this ends. Watch the $92 line like a hawk. It is the line in the sand for the shorts. If that breaks, the short squeeze will become a short obliteration. As we bring this 15-minute deep dive to a close, the signal through the noise is deafening. The halts on the Chicago Mercantile Exchange and the London Metal Exchange are not symptoms of silver S weakness. They are the final desperate gasps of a paper silver system that can no longer bridge the gap between digital promises and physical reality. When you see the screens go dark at $91, it is because the old guard is out of moves. The exit of Benjamin Netanyahu after decades of control acts as the geopolitical exclamation point on this era of instability. We are transitioning from a world of financial engineering to a world of resource reality. The glitch is the warning shot. If you're waiting for a formal announcement that the system is broken, you're waiting for a train that has already left the station. The fact that India is decoupling its pricing from London and China is paying a $39 premium tells you everything you need to know about where the true value lies. So, what is the action plan? First, understand that if you do not hold the physical metal in your own possession, you are trading a permission-based asset. In a world of technical glitches, your digital silver can be turned off with a keystroke. Second, watch the $92 resistance level. A sustained break above $95 is the signal that the short squeeze has entered its terminal phase. We are looking at a potential move toward $127 in the very near term. This isn't just about a price ticker going up, it is about the preservation of purchasing power as the old world order resets. The roaring lion is out, the exchanges are freezing, and the silver spring is fully coiled. Stay vigilant, watch the physical premiums, and don't let the glitches shake you out of a generational position. Thank you for joining me for this deep dive. The next few weeks will likely be the most volatile in the history of the metals market. Make sure you are subscribed and have your notifications turned on, because when the next halt happens, we will be right here to break down the truth behind the glitch. I will see you in the next one.